today's video, we want to talk about a tax planning idea that a lot of people have heard about, but they may not know exactly how it works. Let me preface this by saying, if you do decide to use this tax planning item, work with a professional, whether it's a certified financial planner, an accountant, a CPA, an EA. Work with a professional because there could be some substantial tax implications if not done correctly. Having said that, one of the concerns that we speak to a lot of high net worth individuals about is the fact that they have a lot of money set away in a retirement account that they can't access until they're 59 and a half without having to pay an early distribution penalty of 10%. Or they have significant savings that they're going to be taken out in retirement and they're going to be paying taxes on every single dollar. Now, most people have a lower tax bracket when they retire, but not everyone. And a lot of people, if you want to live a comfortable life in retirement, you may be taking out a lot of money that's all going to be taxable. So one of these tools that taxpayers are able to do under the current tax code is do a conversion from a traditional retirement account to a Roth retirement account. You may be saying, what the heck does that mean? So let's first start by explaining how a traditional and a Roth retirement account are taxed. A traditional retirement account, let's say you put $100,000 in and then take out $1 million in retirement. What's your tax obligation? Well, every single dollar that comes out of a traditional retirement account in retirement is going to be taxed at ordinary income tax rates. So let's say your effective tax rate is 20%. You'll be paying 20% taxes on $1 million. That could be a $200,000 tax bill. It's a lot of money. Now, let's say you didn't wait until you were 59 and a half. Well, now you're taking out that $100,000 account that grew to $1 million. If you take this out before 59 and a half, or you don't have one of the other required situations to take that money out, well, now you're going to have to pay a 10% early distribution penalty on top of the taxes you owe. On $1 million, that's another $100,000. So when you add up those two, you could be looking at a $300,000 tax bill on $1 million retirement account. Yikes. Now, what happens if it's a Roth account? With a Roth, let's say your $100,000 account grows to $1 million and you decide to take this out in retirement. What's your tax bill? A big zero. 200,000 minus zero, that's a $200,000 tax swing. Now, if you do take out this money before you're 59 and a half, the $100,000 that you put in initially, how much are you going to pay in taxes on that? Zero. So once again, take an early distribution on the $100,000 that you put in, $0 tax liability. Why is that? Well, when you put the $100,000 into this Roth account, you did not get a tax deduction for that contribution. So you had to take that income in, pay taxes on it, and then fund that Roth retirement account. Now, you may not get a deduction on the $100,000 that you put in, which may have been, 20% tax bracket, let's say a $20,000 tax deduction, but you were able to save $200,000 when you took the money out. So you traded a $20,000 deduction for $200,000. Pretty good. Now, with the traditional IRA, you have to pay taxes on all these amounts in retirement, but you're able to deduct that $100,000 that you put in. So you did get approximately, let's call it a $20,000 deduction. So net effect here is $200,000 in taxes in retirement, $20,000 deduction initially. You're still paying about $180,000 in taxes versus a total tax liability of $20,000. So that's $160,000 swing in taxes. That's a lot. Now, how can you put your money into a Roth? And why doesn't everyone just put their money into a Roth? Well, there's very strict rules around how much you can put into a Roth retirement account, mainly due to how much money that you make. So if you make too much money as an individual or as a household, you could find yourself locked out and not able to put money into that Roth account. So it may not be an option to you. But under the current tax code, you are able to convert traditional retirement accounts into a Roth account. Now, the way that this works is any of the funds that you would be paying taxes on in retirement or when you take the money out. So any money that you put in to the traditional account that you took a deduction on, or any of the gains, right? Any of that $900,000 gain, you would have to pay taxes on those amounts when converting to a Roth. So why would you do that? Well, let's say you convert the $100,000 into a Roth. Now that money can grow to $1 million, $10 million, however much it does end up growing to, without ever having to pay taxes on that money again. So a good way of thinking of this is, would you rather pay taxes on the small little seeds that you plant or the big harvest that grows into, right? We'd rather pay taxes here. So a conversion is something that allows you to do it. Now there's a lot of rules and regulations in doing a conversion to make sure that it's done the right way. Also, when you do make that conversion, you're gonna have to pay taxes, mostly using funds that are not in that account. So if you convert $100,000 and owe $20,000 in taxes on that conversion, you're gonna have to find $20,000 outside of that retirement account to pay the tax bill. So from a tax planning standpoint, we see a lot of clients, a lot of prospects, a lot of people we talk to make these conversions in years that their tax liability is going to be much lower. Maybe it wasn't a good year in business. Maybe they changed jobs. Maybe they had a loss that can be used to offset that conversion. Whatever the case may be, talk to a tax professional and make sure that it fits your situation. The end result is that you could have significant tax savings down the road. One more massive benefit, let's say 59 and a half years old is way down the road, and you want to access these retirement accounts because maybe the majority of your savings are in these traditional retirement accounts. How can you do that? Well, once you make this conversion, there's what's known as a 5-year rule. After 5 years from the date that you make the conversion, you can then access the amount that you converted and take it out. No taxes, no early distribution penalty. Let me say that again. The amount that's converted after 5 years, you're able to take those funds out because the taxes have already been paid. So if you're 30 years old and have $100,000 that you convert into a Roth, you have to pay the taxes up front, but after 5 years, you'll actually be able to access that $100,000. So that's pretty significant. You're basically taking that money out 30 years before you have to without paying penalty. So pretty substantial benefits. So hopefully this gives you a little bit better of an idea. Obviously there's a lot of moving parts, a lot of stipulations. If the conversion isn't done correctly, the IRS is going to tax it as if you were taking a distribution. So you're going to pay taxes and you're going to continue to pay those penalties, which we're trying to avoid. So if you have any further questions, feel free to reach out to us. As always, down below, there's a link to schedule a complimentary strategy session where we're happy to hear about your situation and determine if this conversion may be a good or bad idea for you given your circumstances.